Today we're going to go over inventory and how it's calculated. Most companies use two different techniques called FIFO and LIFO. Yeah. So last in, first out versus first in, first out. First out. Yeah. So the first in, first out is believed to be the oldest inventory that will be sold first. For most businesses, the FIFO approach is typical inventory method. Because of the inflation, FIFO results in a lower cost inventory. Lower cost items are typically older, but if we look at the last in, first out, LIFO, it's more of a recent inventory cost appraisal technique that implies that the newest inventory is sold first, and inventory has a higher cost due to LIFO. But does it make a difference? So if we look at FIFO, for example, it's more accurate. It's better if the cost goes down, results in higher profit and taxes, and it's allowed globally. And if we look at LIFO, we will see that it's better if the cost goes up, it's less accurate, it's less profit, it's lower taxes, and it's only allowed in certain countries. Which one is better, may you ask? Well, it's up to you to use your critical thinking to figure that out, because you all are university students or students of some kind, and one essential learning bit you need to know, it's critical thinking. Yeah. So have a think about that. So let's go into a question regarding this. Yeah. So company X uses LIFO, all right? So calculate the inventory turnover and days in inventory for company X based on LIFO. That's the first one they want us to calculate. The second one is calculate the inventory turnover and days in inventory on a FIFO basis after adjusting for LIFO reserve. Yeah, we could do that. Let's see at our numbers and see what we get. We have a beginning inventory of 900,000. We have an ending inventory of 1.1 million, beginning LIFO reserve of 300,000, ending LIFO reserve for 500,000, cost of goods sold for 8.3 million, and sales for 12 million. Oh, that's a lot of sales. Let's take a look at the first question then. Yeah. So calculate the inventory turnover and days in inventory for a company X based on LIFO. So in order to do that, to calculate the inventory turnover and the days in inventory, we have to look at some formulas. Yeah. So we have to look at the inventory turnover, which is cost of goods sold divided by average inventory. Yeah. And we got cost of goods sold from the question, as you remember. I have it right here. So cost of goods sold is 8.3 million. Yeah. So that we have. So we're going to place 8.3 million on the top side here. And now we just need to find the average inventory. And how do we find the average inventory? We use another formula. Yeah. And that one says that the average inventory equals the ending inventory plus the beginning inventory divided by 2. So we're going to use this formula with the information we got on the previous slide in order to get the average inventory. And when we get that, we're going to place it here on the bottom. Yeah. But in order to get it in days, excuse me, in order to get it in days, we have to use another formula, which says inventory in days is 365 divided by inventory turnover. Yeah. So the outcome of this equation right here, or this formula here, are we gonna place right here? Yeah. That's how it is. So let's take a look how it's done. So as we can see here, that we started with the average inventory and we took the ending inventory. Let me get the pointer. Here we go. So we get the ending inventory right here. Yeah. And then we got the beginning inventory right here. And then we divided it by 2 and we got this sum. Then we took this sum right over here right? So we have the cost of goods sold from the text right here, or it's also in some of your text it might says COGS, yes, but it's just cost of goods sold, yeah, divided by average inventory, and that gives us the turnover pretty much, yeah. What we have to do now is that we have to take this turnover and take it all the way down here. So as we all know, there is 365 days in a year, and we take the 365 divided by 8.3, which will give us 44 days. Yeah, that's pretty simple, but I hope you got it. So we use three different formula. This one, yeah, this one, and this one. These are the three formulas in order to answer the questions. Yeah, and this is the information we got from the question. Next. So calculate the inventory turnover ratio and days in inventory on FIFO basis after adjusting for Lifo reserve. Yeah. So what we have to do now essentially is just to do the adjusting bit, and it looks something like this. So we're going to take the Lifo beginning inventory, which you can find right here, put it right here, and then we're going to take the reserve, which is right here, put it here, and then you're gonna sum them up. Yeah, you're gonna sum this up, take this plus, you get a FIFO inventory. That's pretty much what you need to do. And on the ending part, all you gotta do is take the ending inventory right here. Yeah, and you have to take the ending Lifo reserve right here, and that will give you a FIFO inventory. Yeah. And as you can see, cost of goods sold is already here, cost of goods sold, but there was an increase in Lifo reserve, so it's 500,000 minus 300,000. So it's this one minus this one, yeah, would equal this. So this is our new cost of goods sold. Yeah, so FIFO cost of goods sold equal 8.1 million, yeah. And when we have done the adjustment, all we gotta do is just use the same formulas. And as you can see, there are arrows here. That's not pretty straight for some reason, but we're going to do the same thing. So we're going to find our average inventory by using the beginning right here and the ending right here, yeah. And then when we have the average inventory, we are going to use the inventory turnover formula. And we take the FIFO cost of goods, which we calculated right here, put it right here, right? And then we take the inventory turnover, which we got right here, down here, yeah? And we got 5.8 times. And you probably know what we're gonna do with this one. So we're going to use the days formula. So inventory days, which is 365 divided by whatever we got here. So we take this sum and put it right here. And that will give us 63.1 days. Yeah. So as always, guys, like and subscribe for new videos, and I wish you a good day and good health, and I hope you understand the difference between Lifo and FIFO and how you can calculate it, the average return, inventory turnover, and inventory in days. This was a pretty fast video, but I hope you understand. Yeah, I'll see you in the next video. Okay, bye bye.